Hi, everyone. Welcome to our Blockchain Bootcamp and Workforce Expo session, all about what Mastercard payrails and the technology is doing today, because there's so much going on within this in our world in terms of how we are transacting business, and the currencies are changing. So today we have a special guest on, and I'm going to let him lead the way. Suleiman, how are you doing today?
I'm good, thanks, Jackie.
Yeah.
Glad to be here, and thank you for letting me be part of the blockchain bootcamp.
Yeah, and Suleiman is all the way from overseas in London, and so we're really excited to have him here to share his insights because he's been in this community for quite a bit. I'm going to go off stage while Suleiman takes over, and everyone enjoy the content.
Thanks, Jackie. And everyone, just a sort of short introduction about myself. Suleiman Javid, I am a Senior Council Director at Mastercard. So I look after a lot of our crypto and digital asset products, including stablecoins, tokenized deposits, and all of the other great things that blockchain technology is helping enable. Today, we'll sort of be I'll be giving you guys more of an overview on stablecoins, digital assets, and sort of the future of digital payment rails. And I think in terms of what we're seeing today, one of the biggest changes we're seeing in payments as a whole is sort of the convergence of blockchain technology, digital assets, and traditional financial infrastructure. You've seen over the past, I would say, probably 2 years now, stablecoins gone from being a sort of niche crypto product to becoming an increasingly important settlement asset at the same time. You're seeing tokenization, programmable money, and digital identity, which are now sort of changing how value can move across the internet. But I don't think this is more of an exercise about replacing today's payment systems and payment flows. It's really about understanding why existing rails can work exceptionally well, where blockchain-based infrastructure offers advantages, some of the disadvantages as well, and how the two are really increasingly being integrated. One thing you'll see today's session is we'll look at how payments infrastructure has evolved, why stablecoins matter, the opportunities and the risks they create, and how organizations like us at Mastercard are really helping bridge traditional finance with the digital asset ecosystems. And just to give you guys a sort of more of a context, we'll talk about how money's evolved, why the existing payment rails are sort of under this pressure from stablecoins, why stablecoins have emerged in the first place, where they fit, where they don't fit, what future infrastructure looks like as well. We'll touch on that, why regulation matters, and how Mastercard is looking at enabling the future. So I'm just going to try and push over to the next slide. So in terms of sort of the foundations of digital payments transformation, to understand where we're going, I think it's really important to understand, where we've actually, where we sort of come from. Payments have continuously evolved to solve the same core problem, and that is moving value between people and businesses safely and efficiently. We've sort of moved from physical cash, if we think over the last 10 years or even 20 years, right? People had much more cash as opposed to bank accounts. Now we've got obviously everyone having a bank account. We've got electronic transfers. We have the major card networks. And more recently, we've seen this move to mobile and sort of digital wallets. If you think about each innovation, I think each innovation has improved, either speed, convenience, trust, or accessibility. When we think about card payments, for example, card payments 10 years ago aren't card payments now. When we think about accessibility, for example, institutions, people are far more easily able to access sort of card payments. And I think when it comes to blockchain technology, they really do, or it really does represent the next evolution for the first time, because value itself can move, natively across the internet without relying on sort of multiple intermediaries and maintaining a separate ledgers. If you think about the traditional side of things, you have different ledgers at all of these different institutions, and trying to reconcile that does take time. Now, that doesn't mean, existing payment rails will disappear or just go out into the ether. I think in reality, we're moving towards a world where traditional infrastructure and blockchain infrastructure coexist, each being used where sort of they are most efficient. And I think just sort of in terms of some of the more future trends, if we look at the evolution of money, right? As I said, we've sort of progressed from commodity money to government-issued fiat currencies to electronic money held within banking systems. Card networks then transformed commerce by creating this global acceptance network built on trust, security, and interoperability. And today, I think you're seeing billions of transactions rely on those networks every single day because they provide that consumer protection, they provide the fraud management, they provide the dispute resolution. And I think the important thing is the near universal acceptance element of it as well. And then when we sort of go into the rise of stablecoins, think of it as instead of value moving through multiple correspondent banks or clearing systems, stablecoins now allow digital representations of that fiat currency to move directly on blockchain networks. And I think when you sort of look at future trends, stablecoins do integrate quite well with existing payment networks. They enhance speed, they reduce cost, they're expanding cross-border reach in ever-evolving new financial corridors and financial trends. And I think even looking further ahead, you're seeing several trends beginning to sort of converge. You've got the advent on sort of programmable payments, always-on payments. You've got tokenized deposits, tokenized real assets. We're also now seeing AI-driven commerce, digital identity, and 24/7 settlement. And I don't think these are isolated developments at all. They're really increasingly becoming part of the same financial ecosystem as a whole. And then just a few key concepts. I think when we look at some of the limitations of sort of traditional payment rails, I wouldn't say that they face delays, but there could be a delay in, when you think about cross-border payment, for example, we've moved from days to now minutes. I think you can even get better than that to seconds. Even when you're moving within the minutes, the cost implication is still quite high. There's lots of intermediaries to go through, right? And they operate more so within banking hours and national borders. And I think with stablecoins, a lot of that is eliminated. In terms of the role of stablecoins that they play, as I said earlier, right, you don't have that price volatility exposure at all. When we think of some of the advantages for, say, gig workers abroad, they can receive stablecoins, within seconds into a wallet, and then in now terms, I think they can really spend that moving forward, and that brings back the argument of the acceptance element of all this. Just moving on now to sort of more understanding stablecoins and digital assets. But I think just before that, I just want to take a few minutes to talk about mainly the shift from the traditional rails to sort of the internet native value transfer itself. When we think about traditional payment infrastructure, as I said, it was designed for banking hours, national payment systems, and multiple intermediaries. It served, and I don't think my words would do it justice, sort of global commerce extremely well for its purpose. But I don't think it was originally designed with an internet native economy operating continuously across borders, at every minute, second of the day. And I think with blockchain technology, it really does introduce a different model where rather than passing messages between institutions that maintain their own ledger, you have participants share a common ledger where ownership can update almost instantly, right? So that enables new possibilities like near real-time settlement, programmable transactions, importantly, atomic settlement, which we will come on to, and always-on infrastructure operating 24 hours a day. And I think importantly, I will stress this point, it's not about replacing every payment rail. Different payment methods solve different problems. And I think the future, and I've spoke extensively about this, will be this multi-rail system where you're allowing payments to be routed across infrastructure that's appropriate for a specific transaction. I think just moving on now to understanding stablecoins and digital assets, I think before we discuss some of the more use cases, some of the important use cases as a whole, it will be helpful for the group and everyone to help distinguish between digital assets. I know you guys have probably spent the last few days learning all about stablecoins, digital assets. I think I'm going to differentiate between cryptocurrency, stablecoins, etc. in general. So crypto, such as Bitcoin, Ether, generally, I would say, derives its value from market supply and demand, and often exhibits price volatility. Stablecoins completely different, right? They're maintained or designed to maintain a stable value by referencing an external asset. That external asset for the large 99% of the world today has typically been the fiat US dollar. And generally, the the stablecoin is backed by reserves or other sort of stabilization mechanisms. And when I say other stabilization mechanisms, I won't go into that because I'm talking more about the algorithmic stablecoins. But at a high level, the ecosystem as a whole consists of issuers who create stablecoin. There's reserves backing the assets. There's blockchain networks where the tokens circulate. There's wallets that store them, and exchanges and all payment sort of providers that allow users to move between fiat and digital assets. So you've got the on-ramp and off-ramp element of it. And together, sort of these components create an ecosystem, I say, where value moves digitally while the underlying asset maintains a stable reference to a traditional sort of currency. Just moving on in terms of the broader digital asset ecosystem beyond stablecoin, there's also other categories where we have tokenized deposits, which is commercial bank money tokenized. You also have CBDCs. I think in recent times we haven't really seen that take off, but I think over the next few years, and especially looking 10 years down the line, you're really going to see the rise of central bank digital currencies as an alternative to cash, sovereign digital money of most nations. And then when we talk about tokenized assets, I won't touch on that too much in this talk. I think that could be a whole topic within itself. But what they really do in terms of tokenized assets, they sort of enable on-chain ownership, atomic settlement, and really help reduce counterparty risk. There's numerous examples in the market of real-world tokenization happening, tokenization of US treasuries, which we're seeing some major institutions do. I'll move on from this slide. In terms of why stablecoins matter for payments as a whole, so some of the benefits that stablecoins offer, the first is speed. Transactions settle much faster than many traditional cross-border payment systems, right? The second is availability. I think blockchain networks generally operate continuously rather than sort of during banking hours. That in itself is a major advantage for any institution. The third, and sort of underspoken, I would say, advantage is programmability, right? Payments can now include embedded business logic. They can enable automated escrow. You also have this concept of conditional payments. And I think moving forward, you're going to see machine-to-machine transactions as we build out the agentic stack worldwide. And when I say we, I mean the sort of institutions of the world and the builders of the world as opposed to Mastercard. So I thought that was important to clarify. I think finally, stablecoins generally have the potential to really reduce complexity in certain international payment flows where you have multiple correspondent banks, that have traditionally been involved. Stablecoins really do offer a sort of advantage there. I'm going to touch on the drawbacks before I touch on the use case. They're not without the challenges, I'd say, right? There's still regulatory uncertainty, which continues to evolve across jurisdictions. The rules in the UK can be different to the rules in the US, although both the FCA and the Bank of England have recently published their policy statements in the UK. In the US, you obviously have the Genius Act as well, which is providing the regulatory clarity. I think users as a whole of stablecoins, whether you're a financial institution or a retail user, should always consider reserve transparency, what the operational resilience is of these stablecoin issuers, some of the more cybersecurity risks as well, because these are governed by smart contracts. So custody arrangements are quite important, and general sort of financial crime risks. I think another thing is there are also broader policy considerations around monetary sovereignty, consumer protection, because at the moment stablecoins aren't subject to consumer protection rules. And if you're a regulator, you're going to be considering the systematic risk if adoption does become widespread across a jurisdiction. And I think an important thing to bear in mind, I always say the technology works, but it's not sufficient alone. Trust, governance, and regulation are very much equally as important components of successful payment infrastructure. And just moving on to sort of some of the broader use cases. Today we're already seeing practical applications emerge. Cross-border payments and remittances are probably some of the more mature examples. It's being used in payroll, supply payments, intercompany transfers. I know there's many a company which I won't name that's already doing this today. It works, and it works rather successfully. I think they're also being explored for treasury management, merchant settlement. Merchants can get paid faster with less fees potentially. B2B payments is another really good use case. As I said, payroll is quite important, especially when we start thinking about gig workers or workers in jurisdictions where the currency fluctuates a fair amount. Some of them would rather get paid out in a, say, USD stablecoin, right? It's quick, it's easy, efficient, and it's a good hedge against inflation for some of them. And I think looking further ahead, you may see support for AI-driven commerce, the Internet of Things payments and programmable financial markets, where money and assets move together on chain is quite a unique and important use case as we're going through. But I think the common theme that you should take away from many of these use cases, whether it's treasury management, whether it's cross-border payments, is improving efficiency whilst maintaining trust and regulatory oversight is a very common theme you're going to see, not just in the US, but other major jurisdictions as well. Just moving on to sort of next slide. So in terms of like the future of digital payment rails, I think looking forward, payment infrastructure this is just my opinion, I should clarify that, would likely become increasingly connected rather than fragmented, right? I think that's the vision that we all see, and we should all work towards. Consumers shouldn't need to know which underlying rail they're using, for example, or whether value is moving via card, account-out payments, stablecoins, or tokenized deposits. That element, I think, should really become largely invisible for the consumer or even businesses. What matters is, that payments remain fast, secure, interoperable, and trusted. And I think achieving this does really require interoperability between public blockchains, between banking infrastructure and existing payment networks, alongside a set of common standards, which covers things like identity, compliance, and settlement. I think those three areas are going to be really important as we're going through the next few years of really driving this change towards this. And I think ultimately the future isn't about choosing between traditional finance or decentralized finance or blockchain. It's really combining the strengths of both. And I think that's what major institutions are looking at today. They're looking at how best do we bridge the gap between traditional finance and this new form of finance, which can enable on-chain activity. And just talking about some of the more programmable nature and always on aspect of these sorts of payments. So with programmable money as a whole, and when it comes to, say, this new digitally native token on chain, you can now execute logic via smart contracts, enable conditional payments. If you think about a house purchase, for example, traditionally, and I think this is quite an important place where I think programmable payments can help or reduce a lot of the friction and create efficiency. A house purchase, you would have multiple intermediaries involved, you would have multiple potential payments involved, and all of those payouts are usually now triggered by a human. But I think if you embed programmable logic into a house purchase, for example, you could have the land registry being paid once the transaction completes. You could have the attorneys or the solicitors, as we call them in the UK, pay out to their clients, all with a simple click of a button. For example, upon completion, pay X 100,000, pay land registry 25,000. You could also embed tax logic into that, and I think that's really a key area where I see a lot of efficiency being created. In terms of where stablecoins could fit into that, stablecoins provide that stable unit of account, essential for these automated workflows. If it's needed in the UK that you have a GBP pound to execute this and that stablecoin is accepted, that would make life a hell of a lot easier, I believe, in that sort of particular use case as well. Just going to move on to another sort of important topic whilst I try and get this to work. Yeah, in terms of the sort of convergence of payments, commerce, and tokenized assets, I think the biggest transformation isn't really, simply new forms of money. It's the convergence of, as I said, payments with digital commerce and tokenized assets. And as you're seeing financial assets become tokenized, payments are increasingly becoming part of the transaction itself rather than a sort of separate process. For example, purchasing a tokenized bond or property, it could involve, as I said, payment and asset transfer occurring simultaneously, right, through atomic settlement. Programmable payments or programmable money also allows commercial logic to be embedded directly into payment flows. And I think this creates the opportunities that you want to see and need to see across supply chains, capital markets, digital commerce. It will, in my view, reduce a hell of a lot of reconciliation and really increase automation across the board. I think this is really a long-term opportunity I see in an economy where value moves seamlessly as you're seeing information move across the board today. Just going to move on to the next slide. So in terms of risk, regulation, and trust, I wanted to touch on this because none of this innovation actually succeeds without trust. Throughout financial history, you've really seen, I just need to go on to the next slide here. Yeah, so throughout financial history, we've seen adoption has really depended not only on better technology, but also confidence in that system. And I think that's why regulation plays such an important role, right? Effective regulation supports consumer protection, operational resilience, reserve transparency, having appropriate financial crime controls, which is a really important risk for a lot of these regulators, and more importantly, maintaining the integrity of the market, whilst allowing for responsible innovation to continue. And I think you're going to see industry standards around identity, interoperability, and governance being equally as important as well. And I think ultimately, trust is really the foundation that enables new payment infrastructure to scale globally across the board. I'm just going to quickly move on from this slide. So in terms of what Mastercard's role has really been within the sort of traditional financial system, and more recently how we've been delving into the future of digital assets. Just going to move on to the next slide. It's really about bridging the payment rails, I would say, and connecting traditional financial infrastructure with the digital asset ecosystem, rather than viewing them as sort of competing models. I think publicly we have stated, that regulated stablecoins are part of the evolution of digital payments, and we are integrating multiple support for different stablecoins, including USDC, USDG, PYUSD across our networks for use cases such as merchant settlement, cross-border payments, and on and off ramping. We've also developed other products, which I will come on to. But in terms of the support for stablecoins, it's giving businesses that choice, whether they want to support USDC, USDG, we will enable that support. And all of this, leverages our existing trust at the end of the day. And I think when you have institutions like Mastercard adopting all of this, you will know that we will create, these seamless experiences without really thinking too much about the trust side of things, because that is built in and inherent into everything that we do. In terms of some of the more capabilities, so we developed the multi-token network, which is designed to enable secure and interoperable blockchain-based transactions between financial institutions, and all of that supported programmable payments, tokenized deposits, tokenized assets. And we've also heavily focused more on the trust and compliance side as well, right? So solutions such as crypto credential, they establish the verification element of it. These are really standards for blockchain participants. And I think that particular use case and product is really, really important, because I think the trust and compliance element is really, really missing in this industry at the moment. And I think overall we've publicly stated that the approach isn't, to replace existing payment infrastructure, but really to build that interoperability across all of the different products and services we offer, creating that choice that you really want while maintaining the three important topics I've been harping on about for the past 20 minutes, which is security, compliance, and global scale. So in terms of how we look at in creating this interoperable global payments piece around digital assets, I think our neutral trusted network position really does help with that. I think when you have this neutral stance, you can really lean on that because you're providing that choice, you're providing that gateway almost for businesses, merchants, consumers to think about these different payment choices that we offer without compromising on the trust element of it. And when you focus on being more of an orchestration layer, right, rather and routing transactions, you have a sort of different perspective on a lot of these things, which I think is quite important as we build out our product stack in this area. So I think that was the end of the presentation that I had. Thank you everyone for listening in. One thing I would say, there's only so much I can say when it comes to Mastercard products and services. Please do look at our publicly available website, where you'll find a lot of the information that I've been briefly speaking about when it comes to our products and services. We're heavily active in the space. A few other areas I want to touch on is we recently announced that we're joining Open Standard, which is the new stablecoin called OUSD. There are many players that are joining and being part of this. I think that should give you an idea of the direction that the industry is going in. Another thing to sort of bear in mind is we have the benefit of seeing this from two different lenses, right? You have the benefit of seeing it from the traditional lens, which is your existing card payment rails. And then you have this new lens, which is your financial payment rails on blockchain technology. I think having such experts around me, or whether at Mastercard, which can bring that knowledge from both sides of the house, I think it's really important. But I think just to conclude really quickly, the way I see it is digital payments are entering a new phase. Stablecoins and blockchain tech as a whole introduced capabilities that were previously, in my view, difficult to achieve or near enough impossible. When we think about programmable money, continuous settlement, and the native digital value transfer on the internet. But I don't think the future is built using technology alone. It really does depend on what the regulations say, that trust element of payments and interoperability, which is really important. And I think the most successful payment ecosystems will combine the resilience of traditional finance with the innovation of blockchain technology, and create an infrastructure that is really faster, smarter, and more inclusive. And that inclusivity will reach globally. But thank you for having me, Jackie. I'm happy to take any questions if needed.
We appreciate your being here, and for those that are in the audience or those that are watching after, definitely send your questions to us so that way we can reach back out and provide the answers to you. Thank you so much, Suleiman, for being on. We are about to go to our next speaker, and we appreciate you. Thank you, everyone. Stay in your seats or get coffee and then come on back, and we will start our next presenter. Thank you so much.
Thanks, Jackie.